So recently, Mr. Lu released a video explaining his cash buying strategy. This time, he even built a calculator to show how the strategy works using historical data. And to his credit, this approach has worked really well for him in the past. For example, when the markets were crashing a few years back, he made several videos announcing that he had fired his short. And when we look back now, those buys were made really close to the market bottom. But in this video, I want to respectfully disagree with the crash buying strategy. Not because it does not work, but because when I look deeper into history, I found that there were also long periods where this strategy would have underperformed. Also, before I go any further, I want to be very clear. This is not an attack against Mr. Lu Ya. His intentions for sharing this strategy is clearly good, and he has helped many people start their investing journey. My goal here is simply to add more context to the discussion so that as a community, we can understand the trade-offs involved and decide for ourselves whether this strategy truly fits our own investing style and long-term goals. So with that being said, let's jump right in. So for those who may not be familiar, crash buying is a strategy where you wait for a market crash before deploying your capital. In Mr. Lu's case, instead of guessing when to buy, he predefines how much money to deploy at different levels of market drawdown. For example, when the market falls 10% from its peak, the strategy would deploy 10% of the available cash. At a 15% drop, it deploys another 15%, and this continues progressively. By the time the market falls 30%, the strategy would have fully deployed 100% of the capital. The underlying idea is that large market declines are rare, and crash buying is designed to make sure you take full advantage of these moments, rather than freezing up at the best moments to buy. In the crypto space, this idea is called rainbow weighted averaging, where investors will allocate more capital as prices fall further below long-term trends. In traditional finance, this same idea is more formally known as value averaging, where you invest more as prices fall. So it's not as though Mr. Lu anyhow came up with this strategy, yeah? This strategy really exists, and in fact, it has been extensively researched on before. Now, in Mr. Lu's video, he backtested this crash buying strategy across a few specific starting dates. One of the dates he highlighted was 23rd March 2018, which was just before the sharp sell-off during the Trump-China trade war. I ran the same period through my own calculator as well, because, you know, I'm something of a white coder myself. And when you look at the results starting from this date, using the crash buying strategy, the portfolio achieved roughly a 170% return and outperformed both the lump sum investment and the dollar cost averaging strategy over the same period. Another starting date that he used was 29 November 2019, right before the 2020 COVID crash. Once again, the crash buying strategy performed exceptionally well. The third date was 29 November 2021, just before the inflation-driven sell-off and aggressive rate hikes in 2022. And once again, crash buying outperformed the other two strategies. Quick pause. If you're looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry, at just 35 cents per trade on the US stock market. It also offers Ireland domicile ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. Now, to really understand why these outcomes look so good, we need to take a step back and see what all these periods have in common. If you look closely at all three charts, you will notice that in each case, a major market crash occurred very early in the investment period. This creates the ideal environment for crash buying because you get to deploy your capital after the market has dipped, but at the same time, you get to avoid the initial drawdown altogether. In contrast, both lump sum and dollar cost averaging are already invested when the crash hits, so they experience the full decline at the start. But then, what if the crash doesn't happen at the start? Take 5th November 1996 as an example. This was when the then Fed chairman, Alan Greenspan, famously warned that the markets were experiencing irrational exuberance, and many people expected a crash. Instead, the market went on to rally for almost 3 more years before finally collapsing during the dot-com bubble. If we use this date as the starting point, the results will look very different. Using the crash buying strategy, the total return was about 510%. In comparison, the lump sum investment strategy returned roughly 818%, while dollar cost averaging returned around 717%. The reason is straightforward. At the start of this period, there were only small pullbacks. Because of that, the crash buying strategy only deployed a little bit of capital here and there, while the major crash only arrived much later, in 2000. But by then, lump sum and DCA had already been fully invested for years and benefited from the long bull markets leading up to the crash. And because crash buying stayed largely in cash early on, it significantly underperformed. Here's another example. 1st January 1990. Once again, there was no major crash early in the period. In fact, the next big crash didn't arrive for almost 8 years. While the crash buying strategy was still waiting for that big crash, both lump sum and DCA had already deployed capital early and participated fully in the market's growth. As a result, both strategies produced nearly double the returns of crash buying. We can go even further back, starting from 1st January 1950, a time when many of our parents weren't even born. Here, the same pattern appears. There was no large crash early in the period, and because of that, crash buying once again underperformed both lump sum and DCA over the long run. Now, this isn't limited to just the S&P 500 alone. If we switch to the Dow Jones, we can see the same thing. Where there is no major crash early on, both lump sum and DCA outperform crash buying. The same applies to Straits Times Index. Starting from the earliest data points that I have, 28 December 1987, there was no immediate crash at the beginning of the period. As a result, lump sum and DCA both delivered better outcomes as compared to crash buying. The MSCI All Country World Index is a slightly special case. Here, a major crash happened early in the data set, which allowed crash buying to outperform lump sum. However, even here, crash buying still underperformed dollar cost averaging a little. That's because while DCA gradually deployed capital over 12 months, crash buying committed most of its capital much earlier. The market continued to fall after those early purchases, which meant that DCA benefited from buying at lower prices later on, while crash buying ended up buying in too soon. Now, let's take this one step further and look at the bigger picture. If we switch back to the S&P 500 and examine all possible starting points, a clear pattern emerges. Crash buying only outperforms a lump sum investment when you happen to start investing just before a major market downturn, such as in 1987, 2000, 2007, 2018, 2020, and 2021. But here's the key issue. Market crashes are rare events, and because of that, a lump sum investment ends up outperforming crash buying most of the time. In this case, lump sum beats crash buying in about 68.8% of all starting periods. In fact, even when crash buying does beat lump sum, the advantage is usually quite small. For example, starting from April 2000, crash buying outperformed lump sum by about 1% per year on an annualized basis. Since 2018, the edge has only been around 1 to 2% annualized. The biggest exception is the 2020 COVID crash, where crash buying outperformed by roughly 5% annualized. In contrast, when lump sum outperforms crash buying, it tends to do so by a much wider margin. In many periods, the annualized outperformance is 2 to 4%, and in some cases, even higher. In other words, lump sum not only wins more often, but when it wins, it usually wins by a lot. The same conclusion holds when we compare crash buying against dollar cost averaging. DCA beats crash buying by about 70% of the time, and when it does outperform, the performance gap is typically larger than the gap observed when crash buying comes out ahead. What all this tells us is that while crash buying can work, it does not consistently deliver meaningfully higher returns. Even when it does outperform, the benefit is often small. But when it underperforms, the opportunity cost can be substantial. Now, according to Mr. Lu, one benefit of the crash buying strategy is that it helps to remove emotion from deciding when to buy during the dip. But I would also argue that this isn't unique to crash buying. Dollar cost averaging and lump sum investing can be just as emotionless, if not even more so. Because while crash buying still requires you to pay attention to the markets, where you need to monitor drawdowns, check whether a crash has occurred, and decide when to deploy capital according to the rules, DCA on the other hand requires almost no effort. You set it up once and then you forget about it. In fact, this feature is available on almost every broker today. For example, on Interactive Brokers, you can simply set up recurring investments and have them execute automatically every day, every week, or every month. I have a video that teaches you how to do so. The same applies to Moomoo, where you can enable auto DCA and completely remove the need to monitor markets. Now, to be fair, I understand why crash buying feels emotionally better to some investors. By holding cash, you avoid having to watch your portfolio fall during a market crash. This is something both lump sum and DCA investors have to endure. So, what if you combine the strategies together? Here, I have a fourth strategy, which is DCA plus crash buying. In fact, this is probably what many investors already do. They DCA regularly while keeping a 10 to 30% war chest money on the side. Then, when a major crash happens, they deploy that extra cash. Unfortunately, when I tested this approach historically, the results are still underwhelming. For example, starting from 5th December 1996, the DCA plus crash buying strategy produced a return of about 709%, while a lump sum investment returned roughly 828%. And if we start from 1st January 1990, lump sum would once again do better. Even on 23rd March 2018, one of Mr. Lu's highlighted ideas, pure crash buying would outperform the best because it avoided the drawdown entirely and deployed capital near the bottom. The DCA plus crash buying strategy actually came in second last. Looking at the broader historical record, DCA plus crash buying strategy does outperform pure crash buying by about 68.8% of the time. That makes sense because you are at least getting some money invested instead of waiting entirely in cash. However, when we compare DCA plus crash buying against lump sum investing, lump sum still performs better about 63% of the time. This isn't surprising because markets tend to rise over time, so putting money to work earlier generally leads to better outcomes. Finally, if we compare DCA versus DCA plus crash buying, the combined strategy does outperform about 85.9% of the time. But there's an important caveat. If you look closely at the chart, the outperformance is very small. In most periods, the difference is marginal, and it is only in more recent years that the gap becomes slightly more noticeable. So here's my takeaway. Based on historical data, I think it's clear that lump sum or DCA are generally better strategies for most investors. And while crash buying does help some people manage their emotions, especially during volatile periods, the data shows that most of the time it simply doesn't perform as well, and its success depends heavily on catching a crash early, something that is both rare and impossible to predict. I want to end with a quote from The Psychology of Money because I think it captures this idea perfectly. The author puts it best when he says that volatility is the price of admission. So he says that like the car, you have a few options. You can pay this price, accepting volatility and upheaval, or you can attempt the equivalent of Grand Theft Auto. Try to get the return while avoiding the volatility that comes along with it. But the money gods do not look highly upon those who seek a reward without paying the price. Some car thieves will get away with it, many more will be caught and punished. The average equity fund investor underperformed the funds they invested in by 0.5% per year, according to Morningstar, the results of buying and selling when they should have just bought and hold. The irony is that by trying to avoid the price, investors end up paying double. Market returns are never free and never will be. They demand you pay a price like any other products. You are not forced to pay this fee, just like you're not forced to go to Disneyland. You can go to the local county fair where tickets might be $10 or stay at home for free. You might still have a good time, but you usually get what you pay for. Same with the markets. The volatility and uncertainty fee, the price of returns, is the cost of admission to get returns greater than low-fee parks like cash and bonds. That's the only way to properly deal with volatility and uncertainty, not just putting up with it, but realizing that it's an admission fee worth paying. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.